Hello everyone, I'm Yazan Ibrahim, or as some of you might know me, Yazan Abu Ghosh. Today we're going to dive into a fascinating and essential topic, Fraud Examiners Section 1, Financial Transactions and Fraud Schemes. Welcome to today's deep dive into the world of fraud, where we'll explore the bribery and corruption. We will start with corruption, then detection of bribery schemes, then conflicts of interest, and at the end, anti-corruption programs. Whether you're an aspiring fraud investigator, a business owner, or simply curious about how organizations manage their finances, or if you are auditor, this journey will shed light on the often complex systems that drive decision making. Bribery and corruption are like shadows lurking within organizations, often unnoticed until they begin to erode trust, fairness, and financial integrity. These acts aren't just minor infractions, they're serious forms of occupational fraud, alongside asset misappropriation and fraudulent statements. To fight back, understanding the intricate mechanisms behind corruption is key. Corruption, at its core, thrives on unfair advantage. Picture an employee using undue influence to favor a supplier contrary to company policies or public trust. These wrongful acts range from bribery, kickbacks, and illegal gratuities to economic extortion and collusion. They're often interconnected, forming powerful multi-layered schemes that are harder to detect and dismantle. The purchasing environment within organizations where deals are struck and contracts are signed is a particularly vulnerable ground. Employees, whether acting solo or conspiring with external vendors or contractors, exploit these situations for personal gain, often at significant cost to the organization.
Let's dive deeper into bribery itself. At its heart, bribery is a transactional exchange, the unauthorized buying or selling of influence. Someone buys influence to sway decisions in their favor, going against ethical or legal obligations. Bribery operates in two domains: official bribery involving public officials to influence government actions, and commercial bribery, which targets private sectors for business advantages. While official bribery has long been a criminal offense, commercial bribery falls into a gray area, with its formal prosecution depending on jurisdictions. For example, the UK Bribery Act criminalizes such actions broadly, whereas US laws lack an overarching commercial bribery statute, focusing instead on specific sectors such as financial institutions. Now imagine this, a kickback scheme. Here, an employee conspires with a vendor, ensuring that fake or inflated invoices are approved for payment. For their role in the deception, the vendor kicks back payment to the complicit employee. Kickbacks are clear examples of a corruption scheme. They rely on collusion rather than outright theft, which classifies them differently from asset misappropriation. The purchasing process is a common target, as employees in these roles have the strongest relationships with vendors, making these schemes appear like routine business interactions. Take the example of a purchasing agent redirecting deals to a specific company in exchange for a share of the profits. This deliberate distortion of competition undermines market fairness and inflates costs.
Even when there's seemingly no direct overbilling, harm still occurs. When a vendor pays kickbacks to secure a steady stream of business, competitiveness evaporates. Without the pressure to offer better rates or higher quality goods, these vendors start delivering overpriced or substandard materials, increasing the organization's costs regardless. For instance, in one case, an unethical travel agency bribed a corporate purchasing agent with free travel, ensuring exclusive contracts. Over 2 years, this led to the organization paying significantly more, $10,000 extra in airfare alone, than if they had worked with other agencies. Overbilling schemes, another variant of bribery, reveal their deceit in how invoices are manipulated. Imagine an employee approving payments for overpriced materials or inferior goods, all under the guise of legitimate acquisition. Sometimes an unethical manager might procure subpar materials at decreased costs, but bill their company for high-quality products, pocketing the margin as a personal reward. While this typically requires approval authority within the system, fraudsters can be inventive. They might forge signatures, bypass accounts payable controls, or sneak false invoices into the system, exploiting inattentive supervisors. These acts display how the blend of insider malfeasance and external deceit creates a two-front attack on an organization. Illegal gratuities, another subtle form of corruption, emerge in what might appear as innocent gestures of gratitude. Unlike bribery,
These gifts or rewards often follow decisions rather than preceding them, serving as underhanded thank you tokens. Ostensibly harmless, these gratuities can seamlessly evolve into outright bribery.
Now let's move with a captivating scene. Picture a bustling market where several vendors are selling the same product, but one vendor consistently receives all the business. Despite offering lower quality goods at higher prices, this vendor seems untouchable. How is that possible? This sets the stage for our exploration of corruption, specifically through the lens of corrupt third-party practices and the systems designed to uncover them. The shadow world of corrupt third parties. In any organization, vigilance is key. But imagine a scenario where someone, a third party, is working behind the scenes, greasing palms with lavish gifts or extravagant dinners to gain favor. These are just the surface clues of a problem that goes much deeper. Corrupt third parties may masquerade as legitimate actors, but if you pull back the curtain, a different picture emerges. They might charge exorbitant rates for basic services, consistently win contracts without offering competitive advantages, or even have suspicious ties to company employees, like matching addresses or family relations. For example, consider a situation where a construction company keeps hiring the same subcontractor despite a record of delivering subpar work. The subcontractor, unnoticed by most, may be paying cash or funneling fees through offshore accounts to secure those deals. These subtle yet glaring red flags demand attention. Behind the curtain, the role of internal controls. Now let's take a closer look at an organization's own house. Corruption doesn't thrive in sunlight. It lurks where internal controls are weak. Poor documentation, lack of clear roles, and insufficient monitoring are all fertile grounds for fraudulent activities. Imagine holding a sieve full of sand. You think you're holding everything together, but the grains slip through unseen. That's what lax internal controls look like, small unnoticed gaps that let corruption seep through. From inventory records disappearing to vague expenses marked only as miscellaneous, these issues can go unnoticed for years without proper checks in place. For instance, if a warehouse consistently reports unexplained inventory losses, the gaps in record keeping might be more than oversights. They could be conscious attempts to hide corrupt payments. Following the trail, proving corrupt payments. Uncovering and proving corruption may sound like chasing ghosts through a maze, but there are 3 established methods to crack the case. First, the most direct route. Turning an inside witness, someone who knows the game from the other side. Think of this as having a map to the maze. Second, covert stings, though risky and expertise heavy, can catch fraud in the act, like planting a camera in the heart of the labyrinth. Third, and the most detailed, is tracing payments through a meticulous audit. Following the money trail, whether it starts on the books or off, can reveal the lifeblood of corrupt dealings. For example, on-book schemes can be hidden under seemingly innocuous labels like consultant fees or advertising expenses. These payments often leave a trail of bank records, invoices, or even random notes that, when pieced together, tell a complete story of fraud. In contrast, off-book schemes are more elusive. They hide in plain sight by leaving no direct paper trail, relying instead on indirect evidence, such as discrepancies in shipping expenses or customer receipts. Profiling the culprit, the business profile. A crucial step in any investigation is building a business profile, a full portrait that reveals how the suspect operates. Think of it as reconstructing a puzzle. Where do their funds come from? What services do they offer? How are payments made? Cash, check, or something less traceable? By identifying these patterns, you can begin to pinpoint unusual behavior. For instance, suspicious travel expenses paid from an offshore account or an unlisted rebate from a supplier may lead you directly to hidden funds. To create a profile, investigators often rely on interviews with employees and customers, analysis of bank statements, and scrutiny of tax returns and public filings. Imagine peeling back layers of an onion, each revealing another clue, an overlooked account number, an unusual transfer, or a name that appears just a little too often. Corruption dissected, illumination through questions. To fully understand corrupt transactions, you don't just gather data, you interrogate it. Where were the payments deposited? Who authorized the expenses? What's hiding behind a seemingly innocent P.O. box address? Drilling into these details not only reveals where the corruption exists, but also uncovers its mechanics. For example, you might ask, what's the company policy on gift giving? Were extravagant items given to particular employees? And if so, what records support these claims? Such thoughtful, specific questions unravel complex schemes layer by layer. Imagine walking into a bustling corporate office where everything seems to be functioning seamlessly. Contracts are being signed, goods are being purchased, payments are being processed. But hidden within this seemingly perfect system, small cracks may exist. Cracks that, if left unchecked, can lead to fraud on a scale that could cripple an entire business. One of the most insidious forms of such fraud is the conflict of interest. Today, we'll embark on a journey to explore this multifaceted topic, breaking it down into understandable pieces, unveiling its mechanisms, and learning how it affects organizations worldwide. At its core, a conflict of interest arises when personal interests of an employee clash with their duty of loyalty to their employer. While it may sound abstract, these schemes manifest in tangible and damaging ways. Let's dive into the depths of these conflicts through real-life examples and scenarios. The purchasing schemes, when personal gain trumps corporate integrity. Consider this. An employee tasked with purchasing supplies for their company secretly holds a stake in one of the supplier companies. This hidden interest allows them to manipulate decisions in their favor. They might overprice goods, negotiate exclusive contracts, or channel all purchases to their own supplier while sidelining more competitive options. It's not just dishonesty, it's a betrayal of trust. One vivid example involves a purchasing superintendent covertly owning a vendor through a relative. The superintendent's vendor buys items at market prices, inflates them significantly, and resells them to her employer. Her influence ensures that the company keeps purchasing overpriced goods, resulting in substantial losses. These schemes are not merely about profiting. They erode the foundations of accountability and efficiency within the organization. But how do these purchasing schemes differ from general fraudulent billing? Here's a simple rule. When an employee has a hidden interest in the vendor submitting the bill, and that interest is not disclosed to the company, it constitutes a conflict of interest. If the fraud is purely for cash gain and the vendor is unrelated, it's classified under general asset misappropriation. Turnaround sales, the flip that flips loyalty. Now imagine this. A CEO learns that the company plans to buy a valuable office building. Instead of negotiating directly, the CEO secretly orchestrates the purchase through a third party. The building is bought for a lower price and quickly resold to the company at a massive markup. The company is none the wiser, but the CEO and their accomplices make a killing. Known as a turnaround sale or the flip, this scheme is a textbook example of exploiting insider knowledge for personal profit. Unsurprisingly, it leaves the employer bleeding financially, while trust in leadership takes a nosedive. These schemes illustrate how seemingly mundane processes like purchasing land or supplies can escalate into full-blown conflicts of interest when employees prioritize personal gain over their responsibilities to the organization. Diversions and business manipulation, when loyalties shift. Some conflicts of interest aren't as blatant but are equally damaging. Picture an employee who sets up a competing business while still working for their original company. Slowly but surely, they begin diverting clients and projects to their own venture. Maybe they start using company resources, funds, time, or equipment to support their side business. It's not just a violation of trust, it's outright competition, often done covertly. In one case, a company vice president developed expensive equipment using their employer's resources, only to retire and join the very company that acquired the equipment. These insidious activities are deliberate breaches of loyalty, undermining the employer's position in the marketplace. Resource diversions, blurring the lines of loyalty. But what about indirect ways in which employees exploit their positions? Some skirt traditional purchasing or sales schemes altogether and instead focus on resource diversions. This could involve using the organization's assets, whether money, equipment, or intellectual property, for personal ventures. The harm is twofold. Not only does the employer lose valuable resources, but they also lose the competitive advantage that those resources could have provided. Underselling, the hidden losses in sales schemes. Conversely, conflicts of interest can also occur during sales. Picture a corrupt employee underselling goods or services to a company in which they have a hidden interest. The idea is simple: sell well below market value and let their own company gain the edge. The employer suffers tremendous losses, their profit margins taking a major hit. This practice of underselling is dangerous because it's often harder to track until the losses are significant. In one scenario, an employee sold real estate below fair market value to a company they secretly owned, costing their employer $500,000. Combine this with tactics like delaying billings or writing off accounts, and the company's profitability slowly erodes. What can be done? Addressing conflicts of interest requires vigilance and proactive controls. Organizations must implement strict policies to ensure transparency in business dealings. This includes mandatory disclosures of financial interests, stringent checks on employees' dealings, and independent audits. However, the battle doesn't end there. Cultivating a culture of integrity is paramount. Employees should be reminded that loyalty to their employer is not just an expectation, it's a cornerstone of ethical business practices. Throughout this exploration, one thing is clear: conflicts of interest are more than just ethical breaches, they are financial landmines. From purchasing schemes to sales manipulation and resource diversions, these acts of dishonesty exploit the trust placed in employees. Understanding these schemes is the first step toward recognizing and mitigating them, ensuring that organizations remain resilient in the face of fraud. Thank you for watching, and as always, continue learning, stay curious, and we'll see you next video.